Welcome, class, to our review using the PowerPoint slides of the things that I think you should know about the balance sheet and cash flow statement with regard to GAAP and the codification and the rules that are involved there. So um, the codification sections are listed on your syllabus, including 210 classification on the balance sheet, 470 about current liabilities to be refinanced, codification 230 talks about cash flows, and 855 talks about subsequent events. So you can look at those details there, but I want to go over some of the pieces here in this podcast. So typical balance sheet, and there's an example using Procter and Gamble, also podcast showing examples of these, but usually starts with current assets. Just a quick review, we talked about securities last week with regard to trading versus held for sale. Remember, trading is those things that are intended to buy, a company buys with the intent to sell it quickly and make a quick profit. Held for sale are securities that are intended to be held for a longer period of time, but could be sold if the right conditions existed. Trading securities should always be current assets. Held for sale should always, or available for sale, those terms are used interchangeably, should be a long-term asset on the balance sheet. So that's why that comes up here. Discontinued operations, the assets and liabilities of the part of the business that's sold. And we talked about the definition of discontinued operations, a strategic shift being necessary last week. That applies to also the balance sheet as well. An example of how that looks is part of the other podcast, but you basically put all the assets from the part of the business you're going to sell in one line item, and you put it on the balance sheet as a current asset until the year that is actually sold. So any year previous should be broken out separate from the other assets. So that's what discontinued operations refers to. So those need to be segregated and then put as a current asset. And you'll see how that is done on Procter and Gamble. Subsequent events, a little more on this. Subsequent events are things that happen after the balance sheet date. So if your balance sheet is dated December 31st, these are items that happen, or events that happen after December 31st, but before the financial statements are actually published. That's usually a 2-month at least delay. It could be longer than that, where something could happen, and in theory it could affect the financial statements we reported. Now, it's not going to, this only affects the balance sheet, not the income statement, because income statement starts and ends on December 31st. Starts January 1st, goes to December 31st of your calendar year. So anything that happens in January of 2000, the next year, doesn't affect the income statement at all, but it could affect the balance sheet. Now, how do we mean by that? Well, there could be information we get at the after year end that would affect a balance on the balance sheet. So for instance, on your balance sheet, you have accounts receivable, and you estimate how much is not going to be received. So you make an estimate of that. If you got word of that a major customer, I should say, is filing bankruptcy, say in February 1st of the new year, that might put in doubt how much you're going to collect in accounts receivable as of December 31st. Some of those receivables as of December 31st may be uncollectible. It may be a much higher percentage than you originally estimated, not knowing that that company was going to file bankruptcy. So that would be a situation where even though it happened in February, if you know about it before it's published, that would affect the balance on the balance sheet. And therefore, it should be adjusted and disclosed in the footnotes that is why you're doing that. So you would go back, change your allowance for bad debts on December 31st, given that information. So auditors have a responsibility to look at events all the way up until the date that the financial statements are published in terms of what there might affect the balance sheet. Now, other subsequent events may not affect anything on the balance sheet. So, for instance, there may be a change in strategy that happens after year end. Happens February 1 again. But in this case, there is no actual effect on any number on the balance sheet. Now, that change in strategy or new customer or a new shift in how we advertise or something like that could still be disclosed in the footnotes, but it would not change any number. That would be a subsequent event that does not affect the balance sheet accounts or the amounts on the balance sheet. So it's important to be able to think through what kind of a subsequent event it is. All right. You know what a current liability is? Current ratio is a very important. Current assets divided by current liabilities is often used to see how liquid a company is, and of course what is included in current liabilities is a big part of how you do that. And as described in both the codification and in the example of the other podcast, refinancing or a short-term debt that is going to be refinanced long-term under the right situation can be moved from current liabilities to long-term liabilities. And of course, that would affect the current ratio. So if the bank says to you that you need a current ratio of 2.0, take current assets divided by current liabilities, obviously, whether you classify a liability as current or long-term will make a difference in that calculation, and it may be significant enough that it could make a difference between whether you're in compliance with the bank's requirements or not. All right. Then, of course, comes our long-term assets and liabilities. Equity, their example of accumulated other comprehensive income, of course, is the accumulative of just the other comprehensive income. So be careful of that. That should be just the other. The rest of your income, net income, goes into retained earnings. We know that. But your other comprehensive income accumulates into AOCI on the balance sheet. So comprehensive income affects not only the statement of comprehensive income, but also the balance sheet and your statement of changes in equity as well, because this is an equity account. Now, just to return to the idea of a non-controlling interest, we talked about it from the income statement side. That's the part of the business that's owned by a minority shareholder. So if you own 80% of another company, you report all the assets and liabilities on the balance sheet, and then you subtract under the non-controlling interest part the 20% that is owned by the other shareholders, just of the company that you have owned, because you control the assets, because at 80% you're in charge, but you don't actually have all of them owned, meaning if it liquidated, they would not all come to you. You control them on an operating basis to decide what to do with them. But if it came to liquidation, the part that is owned by the other shareholders would go to them. That's the non-controlling interest. So you have non-controlling interest on both the income statement revenues and expenses that belong to that 20%, and on the balance sheet, the assets and liabilities, or the net of those assets and liabilities as part of equity. So, review of the sections on the cash flow. As we're done with that balance sheet, we look at the cash flow. We're going to learn the indirect method. We're going to start with net income. We're going to add back non-cash expenses or revenues. Typical ones that you've learned about before are depreciation, amortization, but there's also things like stock compensation we're going to learn about this semester. Other non-cash expenses, people being paid in stock or with liabilities or something, anything that does not involve cash, any write-offs of inventory, write-offs of various losses, impairments. We're all going to learn about those. We're going to learn several of those as we go forward, but those all would be added back if they're expenses or subtracted if they are revenues from our net income to get operating cash flow. Gains and losses. Gains are subtracted, losses are added. So just the opposite of what we normally think about, because those gains and losses are not cash. So the effect of those has to be reversed in the net income to get cash flow. And then the most involved is the changes in operating assets and liabilities. So our definition of operating assets and liabilities generally is that they are current assets or current liabilities. However, the official definition is that they relate to net income. Most of the time, current assets and current liabilities relate to net income, and long-term assets and long-term liabilities do not. But there are some that go the other way. So the question is, does it relate to net income? So for instance, short-term debt, borrowing for 6 months, is a current liability. But borrowing the money, when you borrowed it, you would debit cash and credit a liability, has no effect on net income. All right. However, a sale on credit affects accounts receivable and sales, which is part of net income. So accounts receivable is an operating asset. The short-term debt that earlier mentioned is not a operating liability. So all changes in operating assets and liabilities, assets that go up use cash. That's the way to remember it. And assets that go down provide cash. And liabilities do the opposite. So if your operating asset goes up, you subtract it. If it goes down, add it. If your operating liability does those things, you do the opposite. The harder sections, and I've given you some examples, Excel spreadsheet to show you some of the harder parts of these two sections, investing and financing. Okay. Cash paid for long-term assets is usually pretty straightforward. That's how much you receive when you sold it. Cash paid can be a little more tricky and usually requires you to figure out, using a T account, how much was spent on the long-term assets. If there were things that were sold and paid for, that's where things get a little tricky. Okay, and it really is as simple as just how much cash you receive when you sell a long-term asset. So remember, we took the gains. Remember, when you sell an asset, like long-term asset, you get gain or loss. We took out the gain or loss here. Now we put back in the cash we received. Okay, so now we have what cash, the actual cash effect. All right, financing, you're going to borrow money. That's an increase in cash. Pay it back. Okay, that's decreasing cash. You're going to sell or buy back stock. Those are financing your own stock, what we're talking about here. Treasury stock, and cash if you're selling it. Cash in if you're selling it, cash out if you're buying it back. And dividends is a cash out. Now, dividends are determined by looking at retained earnings and net income and seeing how much retained earnings should have changed because of net income and how much it actually did. And if it's less than what the net income is, the change, then it must have been a dividend paid for the difference. There are two disclosures that you need to make at the bottom of your cash flow. You need to report cash paid for taxes, cash paid for interest, and any significant non-cash transactions. So I guess you might say that's three if you don't put the taxes and interest together. Those should be at the bottom of every cash flow. Non-cash transactions is an exchange of an asset for, say, stock instead of cash, or a stock is exchange for a bond or some other exchange. Leases, we'll talk about those later, are non-cash transactions as well that may need to be disclosed at the bottom of your cash flow. So remember, your cash flow is explaining the change in cash between your balance sheet, so you need two balance sheets and then an income statement to be able to complete the cash flow. You must explain every change in asset or liability on the two balance sheets. So just keep a kind of a check mark as to indicate which ones you've used so far as you go forward. I'll show you an example of how to move through that as well on a separate podcast. So here's the theory, then you can look at the example, and then you'll be ready to try it for yourself.